Imagine a world where bananas suddenly become the hottest investment on earth, not because they taste better, not because they're healthier, but because everyone believes they'll be worth more tomorrow. That's exactly how financial bubbles start. Let's say a banana costs $1. You buy it to eat. Makes sense. But one day, bananas become harder to find. People start saying bananas are rare, bananas are valuable. So you think, if bananas will cost more tomorrow, I should buy more today. You don't buy bananas to eat anymore. You buy them to sell later for a profit, and just like that, a bubble begins. Now everyone is doing the same thing. More people buying means higher prices. Bananas go from $1 to $2 to $5 to $10, not because bananas changed, but because people believe they'll keep going up. This is called speculation, buying something not for its usefulness, but because you expect to sell it to someone else for more money. Soon, something powerful kicks in. FOMO, fear of missing out. You see your friends making money from bananas. You see influencers talking about banana investments. You start thinking, everyone is getting rich. Why am I not in this? So you buy too. This is herd behavior, when people follow the crowd, even when it doesn't make logical sense. And this creates a dangerous loop. More buyers gives higher prices, gives even more buyers. Then things get even riskier. Banks start lending money so people can buy more bananas than they can afford. Let's say you only have $100, but you borrow $900 to buy $1,000 worth of bananas. If prices go up 10%, you make $100, doubling your money. But if prices drop 10%, you lose everything. This is called leverage, and it makes bubbles grow faster and crash harder. At this point, nobody is buying bananas to eat anymore. They're only buying them to sell to someone else. Prices hit $50, then $100 per banana. News channels talk about bananas every day. YouTube is full of banana experts. People quit their jobs to trade bananas full-time. This stage is called mania, when the entire market becomes obsessed with getting rich quickly. But here's the problem: bananas still grow on trees. Eventually, people start to notice something strange. There are bananas everywhere, but nobody actually wants to eat them. Someone tries to sell and can't find a buyer. That's when panic begins. Once prices start falling, fear spreads even faster than greed ever did. People rush to sell before prices drop further. Those who borrowed money are forced to sell to repay their loans. This creates another loop. Selling gives lower prices, gives more forced selling, gives even lower prices. Bananas fall from $100 to $50, to $10, to almost nothing. This is the moment the bubble pops. Some people do make money during a bubble, usually those who bought early and sold before the crash. But most people lose, especially those who bought late or used borrowed money. They're left holding assets that are now worth a fraction of what they paid. This has happened many times in history: the dot-com bubble in 2000, the housing bubble in 2008. And some experts believe we're seeing similar patterns today in new technologies and speculative markets. The asset changes, but human psychology stays the same. There are a few warning signs. If everyone is suddenly getting rich very easily, if people are borrowing heavily to invest, and if you keep hearing, "This time it's different," prices will never fall. You might be looking at a bubble. So remember, a bubble happens when the price of something rises far beyond its real value, driven by hype, fear, and greed. Bananas are meant to be eaten. Houses are meant to be lived in. And companies are meant to make profits, not just headlines. Don't let hype decide your investments. If you found this explanation helpful, subscribe for more simple breakdowns of complex financial topics. No jargon, just clear ideas. And next time you see everyone rushing to buy the same thing, ask yourself, am I investing or just chasing bananas?